Okay, so welcome everybody. My name is Vanessa Lumen, and I am here representing Civitas Strategies. I have my co-worker here, Melinda Escobar, who's going to be helping us today. And today we're going to be talking about insurance for home-based childcare. Okay, how to protect your family childcare business. So if you can please add your name and where you are visiting from in the chat, that would be fantastic. Okay, so before we get started, this project is supported by the Administration for Children and Families, ACF, of the United States Department of Health and Human Services, HHS, as part of a financial assistance award totaling $5,378,809 with 100% funded by ACF HHS. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but it does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information and recording of this content, including the use of AI, are expressly prohibited. Only non-commercial uses of this work are permitted. So during this session, we're going to cover 4 basic topics. First, we're going to provide an introduction to insurance to help you understand what type of protection you are purchasing and why certain coverages are required to operate a childcare program. Then, we're going to discuss how to interpret insurance coverage, what it really means to carry the minimum required coverage, and how to determine the amount of protection your business actually needs based on your specific situation. We will also review strategies to better protect your business, including ways to save money on insurance, manage claims effectively, and compare coverage options in a more informed and strategic way. Finally, we're going to conclude with a 15-minute question and answer session to address any concerns or specific situations you would like to discuss. So let's begin with the basics. Since insurance terminology can seem unfamiliar or confusing at first, simply put out, insurance is an agreement where you make regular payments in exchange for financial protection if an unexpected event occurs. This system works by spreading risk across many policyholders. In general, those who do not file claims help cover the costs for those who do need to use your coverage. So throughout this webinar, you will hear terms such as premiums, deductibles, claims, and coverage limits. So it is important to understand these concepts before we continue. Does anybody have any questions about these basic terms before we move forward? Okay. So what often surprises providers is that insurance is not only there for situations where something actually goes wrong, but also for situations where someone claims that something went wrong, even if the accusation is unfounded. Frustrated parent, misunderstanding, or even a custody dispute can lead to a lawsuit. Legal defense costs in a civil case can easily range from $50,000 to $100,000 before ever reaching court. Without insurance, those costs could fall directly on you. With insurance, you have legal support and financial protection to help manage those situations. So that is one of the most important reasons this coverage matters. So the problem is that a homeowner's insurance policy has limitations when the home is used to operate a childcare business. Although a homeowner's insurance typically covers the structure of the home, personal belongings, and basic liability as a homeowner, that coverage generally does not extend to activities related to running a childcare business from the home. So this means that once you begin operating a childcare program, your policy will likely not cover situations such as claims arising from accidents relating to the supervision of and care of the children, allegations of abuse or misconduct, or equipment, materials, and resources used for the business. So for this reason, it is important to have childcare specific coverage that adequately protects both your business and the families that you serve. Let's talk a little bit about the coverage types. So these 5 areas can serve as a basic checklist when evaluating your insurance coverage. The first 3 that you see are essential and should be part of every home childcare provider's protection plan. It is important not only to have these coverages, but also to understand that each one protects and confirms whether they are already included in your current policy. The last 2 types of coverage depend more on the specific needs of your business. Business property coverage becomes especially important if you use furniture, educational materials, or childcare equipment that may not be protected under your homeowner's insurance policy. Umbrella liability coverage may also be worth considering if you have assets or savings that exceed the basic protection provided under Texas law. Next, we're going to review each one of these coverages individually to explain how they work and help you determine which ones are most relevant to your situation. Let's talk about general liability insurance. General liability insurance is the foundation of coverage for a childcare business and is usually the type of insurance most people think of when they hear the term business insurance. This coverage helps protect against situations involving physical accidents or injuries, such as a child falling and getting hurt, a parent slipping on the premises, or a toy or piece of equipment causing damage to someone else's property. It is also the minimum coverage required by the state of Texas to maintain a childcare license. However, it is important to understand the limitations of this coverage. General liability insurance covers the accident itself, but it does not necessarily cover the circumstances or professional decisions that may have led to the incident. For example, if a claim alleges that an injury, occurred because of inadequate supervision or negligence in caring for the children, that becomes a different type of claim, and it may require additional specialized coverage. And that's exactly what we're going to be discussing next. It is also important to remember that beginning in January 2026, the minimum required coverage in Texas will be $100,000 per incident. Professional liability insurance focuses on the provider's judgment, decisions, and professional performance. While general liability insurance covers the physical accident itself, professional liability coverage protects against claims related to how the incident happened or whether there was negligence in supervision or care. For example, the same incident, such as a child breaking an arm, could lead to 2 different types of claims. One for the physical injury and another allergen inadequate supervision. Even though both claims stem from the same event, each requires a different type of coverage. The good news is that many insurance policies designed specifically for childcare providers include both general liability and professional liability coverage. However, it is important not to assume that both are automatically included. Carefully review your policy and look for terms such as professional liability or errors and omissions. If this coverage is not clearly listed, your protection may be incomplete. This is one of the most important types of coverage, and at the same time, one of the greatest concerns for childcare providers because of the serious consequences an allegation can create. The risk is not always about whether misconduct actually occurred, but about the extremely high cost of defending yourself legally when an accusation is made. So regardless of whether it is true or false, situations such as misunderstandings, family conflicts, custody disputes, or even the misinterpretation of a child's comment can lead to investigations and complex legal proceedings. Without the proper coverage, all legal expenses, attorney fees, and potential claims could fall directly on the provider. It is also important to understand that many standard insurance policies completely exclude this type of coverage. So for that reason, after this webinar, we strongly encourage you to review your policy carefully and look for any exclusions related to abuse allegations, misconduct claims, or legal defense costs. Understanding these exclusions is essential to making sure that you have the proper protection in place for both yourself and your business. Property insurance protects the equipment, materials, and resources specifically used to operate your childcare business. It is important to understand that this coverage, does not replace homeowners insurance, since the structure of the home itself continues to be protected under your residential policy. For providers who operate from home, this area can be especially confusing because personal and business spaces overlap. While homeowners insurance typically covers personal belongings, many policies either limit or completely exclude property used for business purposes. So in some cases, business property coverage under a homeowner's policy may be as low as $2,500. So for that reason, it is a good idea to create a basic inventory of the equipment used in your program, including items such as cribs, high chairs, educational materials, outdoor play equipment, furniture, and work computers. And once you estimate the total value of these items, you can compare that amount to the coverage limits in your current policy. For smaller or newly established programs, this coverage may not be an immediate priority. However, for providers with more established businesses and a significant investment in equipment and materials, it is important to evaluate whether there is a gap in coverage. So ask yourself, how much would it cost to replace all of your business equipment if a loss occurs? If that amount exceeds what your homeowner's policy would cover, that is an important gap you should not ignore. Okay, so let's talk about the umbrella coverage. Umbrella coverage is also known as excess liability coverage, and it works as an additional layer of financial protection. Its purpose is to step in when a claim exceeds the coverage limits of your primary insurance policy. So, in other words, if the costs of a lawsuit or claim go beyond what your main policy covers, umbrella coverage helps pay the remaining amount. For many people, especially those whose primary assets are already protected under Texas law, such as their primary residence or certain retirement accounts, this coverage may not be an immediate necessity. However, for providers who have significant savings, investments, additional property, or other assets that are not legally protected, an umbrella policy can be an important tool for safeguarding those assets. Another advantage is that this type of coverage is often relatively affordable because it is only used after the primary policy limits have been exhausted. So in many cases, the cost may only be a few $100s per year. For that reason, it is a good idea to evaluate your personal assets and consider how much could realistically be at risk in the event of a major lawsuit. If the value of your assets significantly exceeds the limits of your current coverage, it may be wise to explore adding umbrella coverage as an extra layer of protection. When you are reviewing an insurance policy, it is common to see two coverage limits written like this: $500,000 over $1 million. Many people focus only on the first number, which represents the limit per incident. But the second number, the annual aggregate limit, it is just as important. The aggregate limit represents the maximum amount the insurance company will pay in total during the policy period, regardless of how many claims occur. So this means that if multiple incidents happen within the same year, all claim payments come out of that same total amount. Once that aggregate limit has been reached, coverage is no longer available until the policy renews, even if there was still coverage remaining for individual incidents. So for this reason, it is important for each provider to evaluate coverage based on the size and risk level of their program. A provider with fewer assets and lower exposure may never come close to reaching those limits. However, larger programs with more children, staff, or higher risk activities should carefully consider whether their policy aggregate limit is sufficient to protect a business in the event of multiple claims within the same year. Beginning in early 2026, Texas will reduce the minimum required liability coverage from $300,000 to $100,000 under state law. However, it is important to think carefully about what that amount can realistically cover in a serious situation. A simple major incident, such as an injury requiring surgery, hospitalization, and rehabilitation, could easily result in medical expenses reaching or even exceeding $100,000 without including legal fees, defense costs, or potential settlements. The previous $300,000 minimum existed for many years for a reason, and many childcare professionals still consider it a basic starting point rather than a maximum recommendation. That is why it is important to understand that meeting the legal minimum does not always mean that you have enough protection to adequately safeguard your business, your finances, and your professional future. There is an important factor that changes how many providers think about insurance coverage in Texas. The state has some of the strongest asset protection laws in the country. For example, your primary residence, regardless of its value, is generally protected from seizure in the event of a lawsuit. And retirement accounts also receive significant legal protection. This does not mean insurance is unnecessary. Instead, it helps put your true financial exposure into perspective. So before deciding how much coverage you need, it is helpful to identify which assets would actually be at risk if a lawsuit occurred. In many cases, the most exposed assets are savings accounts, investments outside of retirement plans, or other property that is not legally protected. In essence, insurance is designed to help protect those vulnerable assets and provide financial stability in unexpected situations. Understanding what is legally protected and what is not can help you make more informed decisions about the amount of coverage that makes sense for your situation. Choosing a bundled policy or adding coverage through your homeowner's insurance is not necessarily a bad idea. In fact, it can be a good option if your homeowner's insurance company offers coverage that truly meets the needs of childcare businesses. The key is making sure the policy includes essential protections such as adequate coverage limits, professional liability coverage, and protection against abuse or misconduct-related claims. If the policy provides those protections at a competitive price, it may be a practical and cost-effective solution. However, it is important not to focus only on the price. A low-cost endorsement can exclude critical coverage that may appear to be a good deal at first, but it can leave significant gaps in your business protection. The goal is not to simply find the cheapest option, but to make sure that the coverage is truly appropriate for the risks and responsibilities involved in operating a childcare program. The main risk of combining your homeowner's insurance policy with your childcare business coverage is that the two become connected and dependent on one another. In Texas, the homeowner's insurance market has changed significantly in recent years due to rising premiums, coverage adjustments by insurance companies, and in some cases, policy cancellations or non-renewals in higher risk areas. When your childcare liability coverage depends directly on your homeowner's insurance, any change, cancellation, or modification to that homeowner's policy can immediately affect the protection of your childcare program. So this could leave your business exposed or without adequate coverage at a critical time. So for this reason, many providers find it safer to keep their childcare liability coverage separate from their personal homeowner's insurance. While this may involve a slightly higher cost, it provides a greater stability and ensures that the protection of your business does not depend on changes made to your personal homeowner's insurance. It is important to honestly evaluate the level of risk in your childcare program. Not all programs face the same level of exposure, and certain services significantly increase the need for broader insurance coverage. For example, caring for infants is generally considered one of the highest risk areas because if your young children are more fragile, cannot communicate verbally, and some injuries may be difficult to detect immediately. Transporting children also increases risk due to the possibility of vehicle accidents. Activities such as swimming introduce additional dangers related to water safety and drowning, while field trips expose both children and providers to environments outside the normal control of the program. Each one of these factors significantly increases the potential liability of the business and should be considered when selecting an appropriate insurance policy. On the other hand, a simpler program, such as one that is focused on school-aged children without transportation or high-risk activities, may have much lower exposure and require a different level of coverage. The key is to make sure that your policy realistically reflects the specific activities and risks associated with your program. So take an honest look at which assets could realistically be affected in the event of a lawsuit. For many providers, especially those that are just starting out, the amount of exposed assets may be smaller than they think. For others, particularly those with significant savings, investments, or other unprotected assets, the financial risk may be much greater. So the goal is not simply to reduce coverage to save money, but to find a reasonable balance between protection and actual need. Insurance coverage should be tailored strategically to each provider's financial situation and level of exposure. For example, purchasing a $1 million policy to protect only $40,000 in exposed assets may not be the most efficient choice. On the other hand, carrying $300,000 in coverage to protect $2,000 in vulnerable assets may represent a more proportional and practical approach. The key is understanding what you truly need to protect and making informed decisions based on your financial reality and the level of risk within your program. When you are choosing an insurance policy, it is important to remember that coverage is only valuable if you can realistically afford to maintain the premium over time. The best policy is not always the most expensive one, but the one that provides appropriate protection without putting the financial stability of your business at risk. So start by evaluating your current financial situation realistically. Ask yourself what your current premium costs and how a 20% to 30% increase would affect your budget. It is also important to consider whether you could comfortably handle a higher deductible if an incident or claim were to occur. There are several strategies that can help make a broader coverage more affordable. For example, increasing your deductible often lowers the monthly or annual premium. It is also worth asking about available discounts before assuming that higher coverage limits are out of reach. Comparing quotes from multiple insurance companies can make a significant difference, since the cost of very similar coverage may vary by 30 to 50% depending on the insurer. In many cases, paying annually instead of monthly can also provide additional savings of 5 to 10%. Ultimately, every insurance decision involves a balancing protection and cost. Broader coverage provides greater financial protection, but it usually comes with a higher premium. Lower coverage reduces immediate costs, but it also increases personal and financial risk in the event of a major claim. So the goal is to find the highest level of coverage that you can maintain consistently without jeopardizing the financial health of your business. So before we continue discussing the cost of coverage, it is important to clarify the purpose of these 3 questions. The goal is not to create fear or make the decision more complicated, but to help avoid the 2 most common approaches people take when choosing insurance: selecting the minimum coverage only to save money, or choosing the maximum coverage simply out of fear. In reality, both approaches are often emotional reactions rather than strategic decisions. What we are aiming for instead is a clearer and more balanced progress. First, understand the actual level of risk in your program. Second, identify which assets and responsibilities truly need protection. And third, determine what level of coverage you can realistically afford without putting the financial stability of your business at risk. When these factors are considered together, it becomes much easier to identify the right level of coverage and confidently explain why that decision makes sense for your situation. Now that we understand how to evaluate appropriate coverage, let's look at strategies for making that coverage as affordable as possible. Excuse me. The right amount of coverage depends on the specific characteristics of your program and your personal financial situation. For example, a provider operating a smaller program focused on school-age children without transportation services and with limited exposed assets may find that $300,000 in coverage is appropriate for their current needs. On the other hand, a program that cares for infants, provides transportation, or involves higher operational risks will likely require higher coverage limits. The same is true for providers who, over time, have accumulated savings, investments, or other significant assets they want to protect. In those situations, a $1 million policy may provide a stronger level of financial protection. In addition, if your assets exceed the legal protections provided under Texas law, an umbrella policy can offer an additional layer of security on top of your primary coverage. The goal is not to automatically choose the cheapest policy or assume the highest coverage is always the best option. What matters most is finding coverage that realistically reflects the level of risk in your program, the assets that you want to protect, and the financial reality of your business. Adjust coverage means that you are making intentional and strategic decisions about the type and amount of protection that you truly need. After evaluating your program, your risks, and your assets, you may determine that $300,000 in coverage is appropriate for your situation. If so, it may not make sense to pay for a $1 million policy simply out of fear. Your coverage should reflect your actual circumstances, not just a standard number applied automatically. The same principle applies to deductibles. Choosing a higher deductible will usually lower your premium. So it is important to make sure the deductible is an amount that you could realistically afford if an incident occurred. For example, selecting a $5,000 deductible may reduce your monthly insurance cost. But if paying that amount would create a serious financial hardship, it may not be your best choice. So the key is finding the right balance between protection, cost, and financial capacity so that your policy remains both sustainable and truly useful when you need it most. When it comes to discounts, many providers miss out on savings simply because they never ask about them. Insurance agents do not always automatically mention every discount that may be available. So it is important to ask direct and specific questions. A good practice is to ask, what discounts do I currently have? And what additional discounts may I qualify for? Although it may seem like a simple question, it can help uncover real opportunities to reduce your insurance costs. Depending on the insurance company, discounts may be available for bundling policies, maintaining a claims-free history, implementing safety measures, or paying annually instead of monthly, among others. So, taking a few minutes to ask these questions can make a meaningful difference in the total cost of your coverage without reducing the level of protection for your business. Insurance underwriting is essentially the process insurance companies use to evaluate your business history and operations to decide whether they will offer coverage and under what terms. Every time that you apply for a new policy or renew an existing one, a person or system reviews different factors related to your business. One of the most important factors is your claims history, which is why it is important to think carefully about when filing a claim is truly necessary. However, there are other factors that influence the underwriting decision, and many of them are within your control. Maintaining a clean VFPS inspection history, keeping certifications up to date, and having clear, well-documented safety policies demonstrate that you run your program responsibly and professionally. All these factors can positively affect both your policy approval and the cost of your coverage. You can think of underwriting as an interview for your business. The goal is to present yourself in the strongest and most professional way possible. And if you have had claims or incidents in the past, it is better to be transparent about them rather than trying to hide them. Excuse me. Explain what happened and what steps you took to prevent similar situations in the future. Demonstrating what you learned from the experience often builds more trust than trying to ignore the issue. This is something many providers only fully understand after experiencing a difficult situation. Your claims history is one of the most valuable assets of your business because insurance companies use it to evaluate the overall risk of your program. Every claim that you file can affect future renewals and the cost of your premiums. Insurance companies look not only at the severity, of claims, but also at how frequently they occur. Several small claims may suggest an ongoing pattern of risk, while a single large incident may be viewed as an isolated event. For that reason, it is important to use your insurance strategically rather than automatically filing a claim for every minor situation. For example, if your annual premium is $800 and a claim results in a 15% increase, that could mean paying an additional $120,000 per year for several years. Over time, the total increase may approach the amount the insurance company originally paid out. In some situations, especially when the cost of the incident is low, the relationship with the family remains positive and the expense is close to the deductible, it might make more sense to pay the cost out of pocket. However, there are situations where filing a claim immediately is absolutely the right decision. If there is any possibility of a lawsuit, legal threats, accusations, or serious conflict with the family, it is critical to involve the insurance company from the beginning. In those situations, insurance provides not only financial support, but also legal defense and protection for your business. Failing to report a serious situation can ultimately become far more costly than any increase in your premium. It is important to apply this approach every time you consider filing a claim. In many situations, when the amount you would receive after the deductible is relatively small, the relationship with the family stays positive, and the cost of the incident is close to the deductible, it may make more sense to cover the expense yourself rather than involve the insurance company. Over time, this can help preserve a stronger claims history and avoid unnecessary increases in your premiums. However, the situation changes completely when there is any possibility of a lawsuit or legal conflict. If there is anger from a family, threats, accusation, or any indication that the issue could escalate, the best course of action is to file the claim immediately. Even if a lawsuit is never filed, the legal guidance and defense support provided by the insurance company alone may justify using the coverage. So the goal is not to avoid using your policy, but to use it strategically so you can maintain a cleaner claims history for situations when protection is truly necessary. There is also an important principle to remember. If you are unsure about how serious a situation may become, it is better to treat it as a serious and report it. A filed claim can be managed, and any impact on premiums can be addressed over time. Failing to report a serious situation promptly, however, can create consequences that are much more difficult to resolve later. So when in doubt about a potentially serious situation, the safest decision is usually to file the claim. And that is exactly what insurance is there for. So this is a simple habit that only takes a few minutes, but it can make a major difference in protecting your business. In the event of an incident, courts and insurance companies typically place much greater value on documentation created immediately after the event than on information reconstructed later from memory. So for that reason, it is a good idea to maintain an incident log and complete it in the same day the situation occurs. Even if the issue occurred, and document any conversations or communications with the parents as well. Memories can fade or change over time, but a clear, written, and dated record provides an objective and reliable reference. In addition, this documentation can help protect you whether or not you ultimately decide to file an insurance claim. Keeping organized and detailed records demonstrates professionalism, transparency, and responsibility in the way you manage difficult situations. Most providers obtain only one insurance code, often from a well-known or recommended company, and assume that it is the best option. However, this can result in paying more than necessary. For near identical coverage, prices between insurance companies can vary from 30 to 50%. The only way to know whether you are truly getting a fair price is to compare multiple options. A good practice is to request at least 3 quotes and evaluate them carefully, focusing not only on the cost, but also on the quality and scope of the coverage. In many cases, the cheapest policy is also the one with the most exclusions, limitations, or gaps in protection. When speaking with an insurance company, it is helpful to ask specific questions about coverage and use a checklist to compare the responses. In addition, pay attention to how the company communicates with you. If the answers are vague, evasive, or unclear during the quoting process, that may be a sign that the experience could be like if you need to file a claim or seek support. Choosing an insurance company is not just about finding the lowest price. It is about making sure that you work with a company that provides clarity, reliability, and the appropriate coverage to properly protect your business. Workers' compensation coverage is different from other types of insurance that we have discussed because it is not designed to protect you from claims made by families. Instead, it protects you in situations involving the people that you work with. If you operate completely on your own and do not have employees or assistants, this coverage may not be necessary at the time. However, if you have an assistant, substitute, or anyone who regularly helps with your program, it is something that you should seriously consider. In Texas, workers' compensation insurance is not required for many small businesses, which leads some providers to assume they can operate without it. However, it is important to understand the risk involved. If an employee or helper is injured while working and you do not have this coverage, that person could potentially file a lawsuit against you for medical expenses, loss of wages, or other damages related to the injury. The good news is that for smaller programs or businesses with part-time employees, this type of coverage is often relatively affordable. And for that reason, it is worth speaking with your insurance agent, learning about the available options, and evaluating whether this protection makes sense for your structure and the needs of your business. Receiving a non-renewal notice can be stressful, especially because maintaining active insurance coverage is essential for keeping your childcare license. However, it is important to know that even providers with a claims history usually still have options available. The key is to act quickly and don't wait until the last minute. As soon as you receive the notice, begin exploring new coverage options immediately. One of the first steps should be requesting your loss run report or claims history, since most insurance companies will ask for it during the quoting process. It is also highly recommended to contact an independent insurance broker who specializes in childcare coverage as soon as possible. These professionals often know which companies are more flexible and how to present your situation in the most favorable way. Transparency is extremely important during this process. When applying for new coverage, be honest about the non-renewal notice that you received. Insurance companies will typically verify this information, and failing to disclose could create a serious problem or even jeopardize your coverage later on. If traditional insurance companies are unwilling to offer coverage, there are several options available through surplus lines, carriers, or specialty insurance markets designed for the higher risk situations, or more complicated claims histories. Although these policies may initially be more expensive, they can help you maintain continuous coverage while rebuilding your insurance history and expanding your options for the future. So this information may not apply in exactly the same way to every provider, but it is especially helpful for those who prepare their own taxes or work with a tax preparer who is not familiar with how home-based childcare businesses operate. In general, a liability insurance policy specifically designed for a childcare business is considered a legitimate business expense, which means that it is typically fully tax deductible without requiring additional calculations. The situation can be different when coverage is added through a homeowner's insurance policy using a business endorsement or rider. In those cases, it is important to properly separate the portions of your costs related to business use in order to apply the deduction correctly. So for that reason, it is a good idea to request a detailed written breakdown from the insurance company showing the costs and coverage included in the policy. This not only helps you better understand your protection, but also helps maintain clear records for tax purposes. Many providers already use the time-space percentage when calculating other shared home and business expenses. That same principle may also apply to certain insurance costs when appropriate. It is also important to understand that in most situations, insurance payouts are not considered taxable without taxable income because they are generally viewed as compensation for a loss rather than profit. However, exceptions can exist in larger, more complex situations. If you ever receive a significant insurance payment, it is best to consult with a tax professional to make sure that it is handled correctly. The single biggest mistake providers make is waiting until the renewal notice arrives, which is often only 30 days before expiration. At this point, you have no time to shop, no leverage to negotiate, and you're stuck accepting whatever your carrier offers. So put your renewal date in your calendar right now with a 90-day reminder. That's when you have real options. This one little habit done consistently every year will save you money and protect your coverage long term. So if you want, I want to leave you today, not only with information, but also with clear action steps that you can begin implementing right away. So there are 5 simple steps that you can complete this week that can make a significant difference in protecting and strengthening your business. First, review your current policy and carefully check both your coverage limits and any exclusion that it contains. Second, write down your policy renewal date and set a reminder well in advance so you have time to review your options before renewal. Third, contact your insurance agent and specifically ask about discounts that you may not currently be using. Fourth, begin documenting and recording any incidents in a consistent and organized way. Each one of these steps takes less than 30 minutes, but together they can help you save money, strengthen your business protection, and avoid major problems in the future. Okay, so these are additional coaching opportunities that we are currently offering. These are the topics we are offering for micro learning tracks. Or if you have specific needs in your business and you would like one of our coaches to give you a call and work with you one-on-one, these are the topics we are currently offering. So the Texas FCCN is financed by Texas Workforce Commission and operated by Civitas Strategies in partnership with Shine Early Learning and United Ways of Texas. It is a free statewide support system designed exclusively for family childcare providers. So whether you are licensed, registered, listed, or considering starting your FCC business, this network offers targeted resources for your business. The Texas FCCN offers many areas of support, such as professional development, micro-learning tracks, one-on-one expert coaching, startup mini grants, networking opportunities, and upon qualifying, access to cost-saving services. So please visit www.texasfccn.org to learn more. Thank you so much for attending our event today. We invite you to stay connected with the Texas Family Childcare Network through our various contact channels. If you have any questions, need additional information, or would like to learn more about our services, please don't hesitate to reach out. You can contact us via email, texasfccn@civstrat.com, via phone, 210-503-8105, and check out our website, the texasfccn.org website. Our team is ready to support you and answer any questions that you may have about the Texas Family Childcare Network. Ladies, it's been a pleasure, and I hope to see you on another event. Goodbye.